Congratulations for joining us in the Market Insight Virtual Summit. I'm so glad to see you here today. Stay to the end of the training and I'll send you a 30-page report called Winning Trading Strategy. So stay to the end of the video and I'll email this free report to you.
Hi, hello.
Hi, Colin.
Hi, good to see you.
Good to be here.
Yeah, so thankful that you can make it for this interview.
Oh, my pleasure.
Are you
Should be
in
fun.
right now?
What's that?
Are you in US right now?
Yes, I'm in Scottsdale, Arizona. It's going to be a beautiful sunny day here.
Oh,
And it's 7 o'clock in the morning, my time. I guess it's 10 p.m. your time. So I guess I could say good evening or something.
yes.
I just woke up and had breakfast.
Yeah. So are you having the lockdown too?
Oh, yeah. Yeah.
Same thing, right?
Yeah, it's been interesting because my life doesn't change a lot. I'm adjusting my camera here.
Okay.
My life these days in retirement is spent on my website a lot and trying to do my own trading research. Still write a few research papers every now and again on the markets. Still express my opinions on social media. If anybody's following me, you'll see that. I'm not too shy about that. And, so to me, this time isn't all that much different than what I tend to do most of the time, but I have actually played more golf because golf provides social distancing because
Oh, yeah.
especially if you play with most golfers, if one guy hits it on the right side and the other guy hits it over here on the other side, you're 100 feet apart. So you really don't get too close to each other, and it's a good way to have a lot of fresh air, get some sunshine. So they decided that was a safe activity. However, you don't touch the pins. There are no ball washers. There's no wet rags to wipe off your clubs or anything. It's all very you can't touch anything.
Oh, okay. So you still can play golf over there. That's good.
Yeah. So I've actually played more golf than I usually do.
Yeah, I read somewhere that you even won some or went to the finals or some competition.
Oh, I've actually won a few tournaments, and and I've done well in others.
Yes.
It it just like most golfers would tell you, it just who shows up that day, and sometimes you have a little luck, it goes your way, and you add to that some talent, and you prevail, and a lot of other times you don't. It's kind of like trading.
Yeah. Any similarity between golf and trading when you look at golf and how you approach golf and how you approach trading? Is there any similarity?
Oh, there's a whole lot of similarities. The first thing that comes to mind is that there's no way that you could ever be perfect at either trading or golf. There's always another percent return you could have made if you had a little bit more ability to somehow figure out what to do. Golf's the same way. There's always one more stroke. You could shoot the record score of your life and immediately know that you could have done one stroke better if I had just made that putt on 17. So that's one thing. The second thing is it's tends to be a profession. Trading tends to try to find your weak spot. Psychologically speaking, if you're prone to being greedy or gambling, or you like you like the whole thing of trying to get the big kill. It's the same way in golf is going for the par 5 and 2 and over water or something. There's a lot of similarities. And I'm going to mute my phone here. I didn't do that. I apologize.
No worries. So it's a little bit like going for home run in trading, like you want to do that one.
Exactly right. It's the same exact thing. And then the other thing is there's a lot of, to me, practice and research that goes into trading. That's why I spend a lot of time still on the computer. I'm taking a course in C# and trying to build out a little bit more of a trading platform for myself. those types of things.
Mm.
It's kind of, I liken that to go practicing your chipping or putting in golf. It seems on the surface somewhat boring, but it's kind of builds the fundamentals so that you can be a better trader. You don't just all of a sudden come to the trading game and all of a sudden, turn on your quote machine and everything's easy all of a sudden. That doesn't strike me as very likely to be successful. So if there's lots of analogies. I all my life I've golfed, all my life I've traded.
Mm. So there are certain principles that is always correct. Like in golf, there are also certain principles that's right. And is that correct?
If it's always right, there's principles that are always right. Well, yes, I think so statistically. For instance, in golf, putting, if you just did 2 putts on every hole, would be 36 putts. If you made par on the course, you shoot maybe 72. So you end up with half your strokes would be putting. So putting is far more important than most people would give it credit for. And I happen to be a good putter, which helps. But you end up, I think, in trading, it's the same kind of thing. If you can have movement in the markets, then you can have profits in the markets. If you don't have movement in the market, it's kind of hard to buy low, sell high when the market isn't going anywhere.
Understand.
So there's a tendency, there's certain things in trading that are sort of truisms, like let your profits run, cut your losses short.
Correct.
In golf, it's how many greens in regulation can you hit? How many putts can you make? Those types of things are far more statistically important than how far you hit a driver, for
Understand.
instance. So,
And what you're also saying is control things that are within your control. Like in trading, you focus on doing the right thing. And then at the end of the day, things that you cannot control, the result is something that sometimes is out of your control. So you just control is that what you're saying?
Sometimes it's it's windy. Sometimes it's rainy out on the golf course. Same thing, golf. Sometimes, President Trump does a tweet and the market goes nuts one way or the other. And you're in the middle of a position and you get your stops hit. And, that's the nature of the game. It's not anything it's unexpected. It is just something that, you have to build into your thought process and your approach to doing what you're doing.
Understand. Yeah. So what are the few critical things in trading that you must have? Like do you trade like certain setups, or are you a trend follower? Are you a scalper? What kind of things do you particularly look at?
I would always, especially after retirement, I am much more inclined to, do stuff long term. It's just easier. I look at daily data typically. I tend to trend follow. I can get a trade to go off on a trend following trade and just sit there and sit there and sit there, and I don't have to do many things. So I can, leave the office and I don't have to be sitting here glued to a machine all day long, which doesn't strike me as a retirement that I want. So
Understand.
even though I spend a lot of time on the computer, I frequently am I'm taking a course in computer language, or I'm playing around with a research project. I'm not sitting there glued to the quote machine.
Okay, so you're working on trading itself rather than to trade. So you're improving your process rather than to trade.
Yeah, one of the things that struck me back, I was fortunate to think of this back in my 20s probably, was that human endeavor can sort of be broken into 2 camps. There's the things that a machine could do for you, and there's the things that machines cannot do for you. So if you think of it, in today's world, real easily with just a laptop computer, you could set up a small trading operation. You could do it in an Excel spreadsheet. you could actually automatically transmit your orders to your broker without you touching them whatsoever.
Yes.
Now that squeezes out human endeavor, because human, just what I would call the repetitious type of human endeavor that simply does the same thing over and over again. I've probably put in tens of thousands of orders over my lifetime. I'm 67 now.
Okay.
I have no idea. I've never counted them or even tried to figure it out, but it's got to be tens of thousands across all the markets we've done. Now, if you take that and you said a human being had to do those tens of thousands, that gets pretty boring after a while. It's about the same exciting thing that breathing. I mean, you breathe in, breathe out, you don't even think of it. And that's kind of the way putting orders in. But when you get that bored of something, you tend to make mistakes.
Understand.
So a computer doesn't get bored. It just does what you tell it to do. So if you write the program right, it sends the order in. Now, writing that program, that's the other side of human endeavor. That's the creative side. That's the side that allows you to create art, create music, create a new program, create a new trading program that will do something for you and leverage your time. If you spend your time as much as possible building new processes and new ways of telling the computer to do your sort of drudgery work for you, that allows you more time to be more creative, which is a lot more fun than just writing up a bunch of tickets. So I always try to think of my endeavors. I have to, there's some things I do every day that are not automated that I still have to spend some time doing. I mean, I have to take the garbage out to the street, for instance, so it picks up once a week. There's certain things that we don't have robots for yet, but there are a lot of things. The more and more I try to spend time creating new and interesting ways in my life to not have to do the drudgery. And that's fun. I think it's a lot of fun. It makes for a lot of challenges because you're always thinking of ahead and trying to be positive and enjoy the ride, basically, enjoy the ride. See, ETR behind me.
Yeah, this is the website, right? Enjoytheride.com. dot world, right?
.world, yeah.
Enjoy the ride.
Instead
So
of
guys, if you want to learn more about trading, you can go to the website,
Yeah.
enjoytheride.world. There's a lot of videos and trade education materials over there. Yeah,
there's Colin, the aside, I'll tell you a story of how that all got started.
Okay.
My wife and I were sitting there at the pool in Spain one day in October about 2 years ago. And I said, I'm having this problem. People keep sending me emails over and over again, and they ask the same questions over and over again, and I give them the same answers. And I've answered thousands of emails at this point in retirement.
Okay.
I had been retired about 16 years at that point.
Okay.
And I decided, if we could come up with a way where I could asynchronously answer people's questions. In other words, I don't have to be directly in conversation. Like right now, we're synchronous. You're asking questions, I'm giving answers, we're having a conversation. So we're both present. But if you were sending me an email, I could go play golf right now, and maybe I answer your email this afternoon.
Yes.
And then you would answer my email maybe tomorrow.
Correct.
And so that's asynchronous. And so we decided then and there that, hey, how about if we do an enjoytheride.world website, and I will just keep putting my brain, my knowledge of trading into the website, and put things on hedging and things that, books that I think are great to read, videos of me talking about trading, webinar recordings, things that people might help people get into trading and understand some of the basics. That way, again, I'm doing one thing one time, and then it goes to the website, and then people can get education off the website, and it leverages my time. I don't have to, if I've got like 16,500 followers on Twitter, I cannot, if everybody the same day sent me a direct message, it would take me all day long and the next day to try to answer everybody. But if everybody can go to the website and get a lot of answers there, then it's just a lot more efficient way to transfer the information. So that was just my idea. That's the story behind enjoytheride.world. And so far it's been successful. It pays for itself.
Yes.
I don't have to go into my pocket to keep it running, and it's fairly easy to keep it running. I update stuff every now and again and a research paper here and there, but it's a lot of fun. I call
Where
it
are
my,
you?
yeah,
Sorry.
it's my retirement website.
Where are you most active? Because I see you active on Twitter, I see you on Facebook, website. Where, if people want to look for info, look for you or get the latest view from you, where is the best place to look for you? Is it at Twitter?
I usually, when I do something on Twitter, I do the
Okay.
same thing on Facebook. So either one works.
Okay.
I prefer Facebook myself because it has a little bit easier ability to message, and it has a little bit more ability. Maybe I like saying things in long sentences, but the character limit on Twitter drives me nuts sometimes. I go ahead and I've gotten to where I just do my pronouncement that I want to do that in that tweet, and then it usually always runs over, and then I have to go in and change all the ands to ampersigns and throw in a to instead of a to,
Yeah,
and I just kind of like start getting characters out of the tweet.
correct.
And so it's kind of a challenge for me to deal with Twitter. But once I get Twitter done, I always do Twitter first, and then I copy it over to Facebook because Facebook doesn't have the limitations. So I kind of prefer Facebook
Facebook.
in the end, but I use both. I don't do a lot of Instagram. I still haven't figured out, you know,
Me too.
how that's useful. Sometimes I'll throw a chart up there or a picture when I'm on vacation, something, but it doesn't. Instagram is a little strange to me. I haven't figured that one out yet.
Yeah, so you're talking about Facebook. Is your Facebook page or is it your Facebook profile? Is it your
Oh, that's another story.
uh,
Facebook, on my personal portfolio or personal Facebook page, has the limitation of 5,000. And I notice you have the same problem.
yes,
You have so many friends that you hit your limit. Then people keep sending you friend requests, and
yes.
they can't get into, you can't accept them because Facebook will reject it.
Right.
And so I ended up creating a page called enjoytheride.world. So
Okay.
I guess
Right.
it's at enjoytheride.world. And it's the same thing as my normal page. I do all my posts over on my page. You can like that. You don't even need to send me a friend request. Just follow it, like it. You're going to get everything that I ever put out. If you try to do a friend request, I dutifully will process it up to 5,000, and I'm getting closer. So I end up having to reject people. And meanwhile, the page is unlimited. So that's the easy way to go. You don't even have to send me a friend request. And if you like my page, you can always communicate with me by Messenger or whatever. I don't see it as a downside. So you don't need to be my friend.
Coming back to trading, just now you mentioned to enjoy the right to ride the trend. And how do you actually ride the trend? Do you use like a trailing stop loss? Do you use like a moving average?
I'm a big fan of trying to include things like volatility into my calculations. So things like Keltner bands, and Bollinger bands, and Donchian channels are probably my three favorite, because each one has a sort of component of volatility built in. In other words, if it's very volatile market and the bars are very wide or the candlesticks are very wide, you're going to have Donchian channels that are wider automatically.
Okay.
Keltners are based on an average true range. So you have a moving average in the middle of the prices, and you have a top and bottom band based on X times 2, 3 times, whatever, the average true range, which is a measure of volatility. So as soon as the market gets volatile, the Keltner bands start going wider and wider. And the top line is where I like to buy. The bottom line is where I like to sell. Simple. Everything in between is noise. I ignore it.
The top line is where you enter the position.
Enter the position. And the bottom line would be where you go short or get out of the position.
Okay, so you want something to move in that direction.
And I want it to start moving,
Okay.
go through the top line.
Okay.
So now it's no longer noise. Noise is what we ignore in between.
Okay.
Once we get above the top line, it's no longer noise. It's a trend.
True range. It's a real move after you move beyond that.
Exactly. So depending on your time period, I've got some stuff that I do that's 50 days, Keltner bands. I've got other ones that I'm doing where I'm doing some combination indicators on a 9-day basis, very short term. For me, short term, maybe for you, long term. If you're a day trader, that's forever. But I think different time periods can diversify you, different markets can diversify you, different indicators can diversify you. I see nothing wrong with, especially if you can use computers to your advantage, to running several different strategies at the same time, because you can diversify by approach or by strategy. For example, let's say you have a trend following strategy that's a 21-day Keltner band.
Okay.
All right. So that's the first thing you're looking at is a trend following model. And let's say you're doing it across 20 commodity markets. So you're trading gold and Japanese yen, and you're trading the meats, the live cattle, and you're trading, grains and all sorts of things. You have a diversified portfolio.
Okay.
Okay. Sooner or later, you're going to end up with times when that approach is going to end up having a rough time, just by sheer chance. No matter whether you're diversified or not, there's going to be times where statistically they're all going to be kind of not going anywhere. And if it's not going anywhere, that type of an approach is not going to make money. It's going to lose money. So down you go. Well, how about if you have a second approach that trades perhaps those same markets, but does it some kind of a mean reversion where you look at the same range and you try to trade the noise. So you set your stops, you look for a place where your stops are close, you look for it to be stretched out, maybe an RSI stochastic or some kind of a measure of overbought, oversold is included. And when you're overbought, you sell, or when you're oversold, you buy with a tight stop, and you attempt to try to work the range. Well, that's going to tend to make money in the sideways when the other strategy is losing money.
Understand.
So what you end up doing is sort of helping each other, keep the performance sort of a straight line going up the page instead of all the, the up and down. Especially in retirement, I like straight lines just fine. I'm not looking to hit home runs. I'm just looking to try to plod along and increase the portfolio. So it is by diversifying by strategy, it's hard to do if you're doing it all by hand, but if you keep adding it with computers, you can do different things that have different return streams and add them all together and smooth everything out a little bit more. And it makes it easier to enjoy the ride because you aren't, there's always something good happening somewhere, and there's probably something bad, something happening somewhere. And it just sort of evens out your mentality. It doesn't.
So it evens out your equity curve also, right?
Exactly.
So you have just to summarize, you have some strategy that's trend following and following the trend, and then some strategy that are mean reversion. So over time, when the market move, whether it's trending or whether it's non-trending, over time you will smooth up that equity curve. Is that what you're saying?
Yes, exactly. I'm trying to smooth the equity curve every day. Return to risk goes very, very high if you do that, because your risk gets very small, and your overall portfolio risk, the risk of any one position, the risk of any one strategy could be fairly great. But when you add it all together, you've designed it so that it sort of smooths. They fight each other all the time, and that's kind of a good thing. It's just the same thing as diversifying a stock portfolio, where you have, if you could find truly diversification in stocks, that's harder and harder these days, because I noticed that when the United States goes down, Far East goes down, the Europe goes down, we go back to New York and start all over again. it's not real easy to find a place to hide these days out there in the world. When I started back in '74, coming out of college in university, it was a lot easier to get diversification by doing foreign stocks, and there was the currency fluctuation that helped out, and there was a lot more. Nowadays, it's
So tied together everything, right?
yeah, everything's computerized, so it's just as easy for somebody to go on their computer and go into their broker and buy a Hong Kong index or something as it is to buy the S&P, and so it's the type of thing where the world's gotten to be a very small place, evidenced by I'm talking to Singapore right now, live with video. That wouldn't have been possible back when I came out of university. Wouldn't have been possible even a few years back.
Yes, correct. Interesting. Thanks for sharing. In fact, I'm also doing some algo trading on our own. We try to diversify across strategy also. What my main challenge is sometimes, even in trending market, there is high volatility trending market and low volatility trending market. And in so that is always trying to figure out, whether when it's trending, is it high volatility or low volatility? Same thing for when it's sideways market, there is also such thing as in a sideways market where the candles are very long or the candles are very short in a sideways market. So we are also trying to figure this out myself. Thanks for sharing. Kepler channel is something that I haven't tried, so maybe I will look at that. Bollinger Band is something that I use, so thanks for sharing that also. Correct me if I'm wrong. So most of your trading are systematic trading. Am I right to say that? That means it's based on rules that you back test. Is that?
I was a chemical engineer by degree and love computer programming. So I'm still taking courses in new languages. So I'm fairly comfortable sitting at a computer and knocking out a little code. I'm not as good in C#, let's say, that I was back in the Fox Pro days, when that still existed before Microsoft shut them down. And Trendstat, my firm back in the day, had we estimated about $1 million it cost me personally to build Trendstat, all the trading strategies and the platforms and the broker connections and the equity checkouts, and we were handling through over a dozen desks, I think several hundred clients and $600 million in US and across 30 currency pairs, 80 futures markets, about 25 mutual funds we were trading. There's a lot going on. That's a lot of data. There's no way my 10-person staff could handle that without the 40 computers that we had doing all the work. So I've always been a process type of person, because if you think of a chemical factory, which is what chemical engineers think of, you have chemicals come in front side, you process it, you put it in tanks, you heat it up, you cool it down, you distill it, you combine it with other chemicals, and you then ship it out. Well, isn't trading the same thing? You're bringing in data, you're making decisions with it and processing it, you're shipping out orders. Same thing. So I always looked at what we did at Trendstat as a mini chemical factory, except with data instead of chemicals. And I ran it that way. So everything was sort of combined together. The more I could process stuff and the more I could make it efficient, the more the chemical factory ran more efficiently with less errors, and the better we did. So that's just been my slant on life. And it makes life a lot easier. You're not, except if the internet goes down or you don't get any data, and then stress levels go right up, and you have to try to scramble and figure out how you're going to get your orders in. But most of the time it's pretty easy.
So how many percent of your trading right now is like discretionary? Discretionary. That means you still look at the market. Or how many percent is really like just system trading?
It's 100% system and 0% discretion. Yeah.
That's my go-to.
Yeah, I always am kind of amazed that people will direct message me or something and saying, you should really look at, and then they give me a ticker symbol.
Uh, uh,
I, I
yeah.
don't ever look at any ticker symbols. I don't even, I just kind of politely say, not interested because I have everything systematized.
Understand. So
Computer
your
can
C sharp is all learning about back testing, is that right? Is it doing
Yeah,
okay?
what you're trying to do with various languages is just have a platform where you can take a set of data and you come up
Mm,
with an idea. Let's say you say,
mm,
okay, well, we just mentioned Keltner bands a little while ago.
okay, yeah.
So maybe you say, I want to check what a Keltner band would do to the SPYs going back for 20 years. So
Mm,
you get the 20 years of data and you write a little code
mm,
that is just nothing but Keltner band. And by the way, you can go to Investopedia.com and
mm,
get
mm.
the formulas for about 100 different indicators. You don't have to
Yes.
just look at Keltners. There's so many that
Many.
I don't even know them all. I'd have to go to Investopedia. Some people say, have you ever looked at an Arun oscillator? And I'm
Run,
no,
yeah.
I've never even heard of it. And so I just go to Investopedia and I look it up and oh, okay, that's what it's doing. Yeah, yeah, that's interesting. That's different.
Mm,
You
mm,
know,
mm.
there's so many different indicators and there's new ones being invented every day.
Yes.
And what somebody said a rune oscillator. It's AROON,
And
not
yeah,
UN,
yeah.
um, on the
I
chat.
studied that when I did my CFT, a rune. We don't know what is this, so we studied a rune oscillator.
Yeah, I mean, somebody asked me that the other day, about a week ago, and I've never heard of this. So, I mean, I've been around. I've been trading heavily for 45 years, and before that, when I was a paper boy at 12, I bought mutual funds. So I've been
Uh,
in investing for a lot of years,
yeah.
and I had never heard of this indicator. And I thought, all right, I'll go to Investopedia, and there it was. And
Yeah.
with the formula and everything, and I
Yeah.
can look at the math and I can understand what it's doing, and it even gives you an idea of how to use the indicator. But the point I'm making is there's just so many different ways to sort of attack the markets. And I
Mm,
think one of the important things that everybody on this call should think about is what are you trying to solve? What's your personal investing puzzle
mm,
that you are trying to solve? You don't
mm,
want to trade like Tom,
mm,
or I would submit like Colin.
mm,
Each person has his own skill level,
mm,
has his own knowledge of, say, computers, has his own knowledge of math.
mm, mm,
Maybe you are more of a discretionary trader and that works for you because you have that type of mental framework. I'm
mm,
not that type of guy,
mm,
but I've run into people who are excellent discretionary traders. I'm not
mm,
saying you can't be, uh, but with your net worth, your nationality in terms of what country you sit in, the laws of that country on what you can trade, what you can't trade, the
mm,
liquidity of those vehicles, everything is different. You
mm,
can't
mm,
just take what one person does and
mm.
translate it over to another person
Yeah.
super easy, but what you can take is the principles.
Mm,
And that's what I always try to stress to people is to think about what skills you have and how much capital are you trying to trade and what markets are you most comfortable with? Some people are terrified by trading futures. Me,
mm,
I've done it 40 years.
mm,
It's
mm,
like breathing to me, but
mm,
it's a learned skill. I mean, when I was born, I did not have a knowledge of futures. I had to read books. I had to try it. I had to make mistakes. It took me
mm,
4 years to break even. In the
mm.
fifth year, I finally made money.
Okay.
And I think once I got going and I understood the advantages of it, I
Mm,
decided, okay, I got to get better at this, and you just keep doing it. But what I encourage everybody to do is to
mm.
think of sort of a buy sell engine that makes your decision. Think
Okay.
about your position sizing,
Mm, mm.
because, and that's what I wrote a book last year on position sizing, and that's on the website.
Okay.
It's $10. It's not going to break anybody's bank.
Mm-hmm.
And what it is simple math that allows you to say, should I buy 100 shares or
Mm,
200 shares or 150 shares of
mm,
this stock that I'm considering? Because once you know the risk and the volatility, you can then
mm,
go ahead and attempt to do a consistent position sizing. just to buy the same size shares in a whole bunch of different positions means you have different dollar sizes, different volatilities. You're not really balancing the portfolio very much mathematically. So there's lots of easy tricks to do, but if you can build a buy-sell engine, build some kind of position sizing that tells you how much to buy. So now you know whether you're going long or short, how much you're going long and short, and your indicator tells you what price you're going long and short. Now you're starting to get the aspects of creating that first order, and it's for you. It's not for Tom, it's not for Colin, it's not for anybody else on this call. And that makes it easier for you to solve your particular investment puzzle. I think solving or copying somebody else's solution does not necessarily fit yours.
Understand. So you mentioned about position sizing using volatility. Is it like you use some sort of like an ATR to calculate the size instead of the 2% risk? You just based on certain percentage of ATR.
So an easy example, the stock's going up and down $1 a day.
Okay.
You've got $100,000 in your portfolio, and you want to put 1% of that into your position.
Okay.
So you know you got the volatility is $1 a day. You know you're allowed to put $1,000 or 1% of volatility into that position. So you would divide the $1 into the 1,000, and it would tell you to do 1,000 shares, and you would have exactly 1% of your equity at risk to the volatility of that one position.
Understand.
And you could volatility match 10 positions, and they would all have $1,000 of volatility. So one position might be 1,000 shares, the next position might be 800 shares, and the next position might be a very volatile stock. You might only be able to buy 100 shares, but they would all contribute to your portfolio precisely the same at that moment in time.
So instead of measuring size based on capital, you measure size based on volatility. Right.
Yeah, and then risk, you can do it too. You can say, I'm going to buy here and I'm going to sell there. So I've got $1 worth of risk. My stop is at $1. I've got $100,000. I'm going to take 1% risk of any one position. So I can buy 1,000 shares of the stock because I've got a $1. If I've got a $2 risk, then I can only buy 500.
Understand. So the bigger the risk, the smaller you can
smaller the position. And that what that does for you is, and we should address the the latest markets. I mean, this virus crash, you could call it, or whatever. You've had huge increases in the volatilities. Unbelievable. I've seen numbers and I've seen bars and candles that I have never seen in my life of trading. These are so huge, circuit breakers kicking in.
Yes.
It has been fascinating for me to watch. And throughout the whole thing, I haven't changed a single thing I do. All my strategies worked great. It's probably one of the most profitable periods of my lifetime. And so what do you do to deal with that and stay very serene? Well, the easy solution is sizing, because if I don't know, pick an example, short NASDAQ futures or something, and I'm enjoying the ride downward now, but because I've had multiple contracts, let's say I had 10 contracts to create a simple example, and the volatility is now doubled. And I'm now way over the amount of volatility as a percent of my equity that I'm comfortable with that NASDAQ position. And I've already preset those numbers, because I can say, all right, I don't want any more than 2.5% of my portfolio's volatility coming from any one position. Well, let's say I'm at 5% because the thing has gone insane. Well, sell off half the position. Now I've got 5 NASDAQ contracts. I'm still short. I'm still enjoying the ride. I still have got 2.5% volatility of my portfolio. No big deal. It's the same as it was when I was at 2.5% volatility, before the thing started crashing with the 10. So everything stays the same relatively. And with commissions being so inexpensive these days in many places with the electronics and everything, you can adjust your position sizes fairly easily and inexpensively.
Mm.
and that adjusts for volatility. Some
Mm.
people suggest that you could even do it the other way. If volatility got smaller, you
Mm.
could actually increase your position size because
Yes.
you end up with keeping volatility the same again. So you're
Yes.
still staying with your buy sell strategy, but
Mm.
by adjusting your position size, you're keeping everything a little more constant in terms
Mm.
of your mentality and the
Mm.
effect on the portfolio mathematically.
Understand. Interesting. Thanks for sharing, because usually we
Yeah,
just thinking of like percentage of capital, but volatility is something that is a variable that it changes over time.
it
Thank you.
does. And the more you volatility adjust things, the more with changing conditions, you can keep things the same.
Understand. Yeah, because quite a lot of maybe the people attending this webinar, most of them maybe are not into systems. So I think that the main thing to go into a system is to be able to remove the emotion, because sometimes when the market is crazy, would you agree with that? Is removing emotion
Uh,
is really that important?
I think it helps for some people,
Okay.
and I think it hurts for others.
Okay.
So let's go over both. For
Okay.
me,
Mm-hmm.
I'm an engineer. I understand numbers. I understand computers.
Mm.
I understand the limitations of what those computers can do for me.
Mm-hmm.
And in a lot of cases, I'm the one that programmed them so that I know
Mm.
that I'm responsible for whatever happened anyway. For
Understand.
me, that's comfortable. Now, for a discretionary trader,
Mm-hmm.
he's not going to trust a computer. She's not going to trust a computer. They're going to say that this is crazy stuff. You know, you're going to feed data into a computer and out come the answer. That can't possibly work. You got to discretionarily decide. So
Mm.
various personalities and people will
Mm.
have a different way of dealing with automation. For me, process makes it a little bit more simple. Now, let's
Mm.
go to the mental side that you just mentioned.
Mm.
You get into a situation like what we've just gone through, the virus crash.
Mm.
You end up with a lot of people. You say that process, having it all automated and all that helps your mental side. Well, it does for me, and I was able to make it through this whole thing without changing a single thing.
Okay.
However, a lot of I know fully automated traders, literally in the middle of the crash,
Mm.
just shut down the machines
Mm.
and said, "This is so insane, I don't trust it. I don't trust my strategies to deal with this."
Mm.
And some of them may have taken some hits.
Understand. So they
So
override the system.
so they override it. So you got to remember that no matter whether you have computers or not,
Mm.
it's still the human being and your emotions and your mentality and your
Mm.
discipline,
Mm.
because you have the ultimate show. You can always pull the plug on the computer
Yeah.
and turn it off. And so it still comes down to mental. As Dr. Tharp once said, in the end, trading is nothing but mental, because everything comes from your brain and
Mm.
your emotion and all that. And
Mm.
what you do, even if you do it computerized, is a
Mm.
reflection
Mm.
of who you are and your discipline and your ability to keep that process going. So
Mm.
in the end, it's all mental.
Understand. So what will you advise someone to do? Is it based on the temperament, or should they go more systematic, or should they go into more or hybrid kind of model? What is
Well, what I always try to tell people to do is think of it as an inventory of yourself.
okay?
Start with a piece of paper with a blank and write down all your current knowledge of various markets, small, large, whatever it is. Uh, what's your skill level in various things like computers? You have never touched a computer,
Mm.
you don't even own a computer, you operate off of a phone. Uh, there's lots of different things there. Who do you
Mm.
know?
Mm.
Well, all of you know Colin and Tom now because you're on this call. So you have resources out there. There's the enjoytheride.world. There's lots of free stuff there. You can just go on with a browser and start
Mm.
reading research papers and listening to interviews I've done over the years.
Mm.
I've covered just about every trading topic that anybody could ever cover with me. I think I can't imagine something that Colin could ask me that probably has
Yeah.
not been asked at
Only
least once
5 years,
before.
right?
But what ends up happening is once you get this sort of what I would call inventory, personality inventory, what's your capital level? How much time can you spend on trading? If you're working a full-time job and you only have Saturday morning to be able to spend 2 hours before you have to go off and play with the kids, that's got to be your trading strategy. It's got to be a once a week, 2 hours on a Saturday morning type of trading strategy. So maybe you look at weekly candles or weekly bars. There's, again, each person's individually different and very unique. So what ends up happening is once you get that all down, then ask yourself, so what am I trying to achieve with trading?
Okay.
Given this is what I've got, and what you've got is very different than what I've got or Colin or anybody else on this call. Now that you have that, try to read, Trade Your Way to Financial Freedom was a great book that I just loved because it covered the buy sell part of the strategy. It talked about position sizing to some extent, and it talked about the mental side of trading. So it's the one book I like to recommend that seems to cover a wide aspect of all parts of the trading.
Okay.
Once you know what those parts are, without having it solve you the problem, you got to solve your own puzzle to a certain extent. At least you need to have some kind of a way of making a decision to buy and sell. So I call that the buy sell engine. You got to have something that tells you, and it could be discretionary. It could be whenever I see a stock that has a less than 10 PE and less than 10 price, and I can put my risk here, I buy it. So that's discretion. That's not necessarily totally automatable. It may be something that you have to look for a chart pattern or whatever. The thing is, once you have that buy sell engine, then you can say, how much do I buy?
Okay.
And that's the next kind of part of the problem.
Okay.
And then the third part is to have the discipline and the mental and the contingency planning so that you can execute that. You have the mental process and the fortitude and the discipline to actually get that done day after day or week after week. If it's once a week, it's once a week. If it's once a month, it's once a month. I have friends that I help out where I say, do 20 or 10 different ETFs, exchange traded funds. So get one that's a gold fund, get one that's a stock fund, get one that's maybe a tech fund, and find 10 different funds. Every month, just go through and rebalance them so they're all equal.
Okay.
So kind of Robin Hood strategy, you take from the rich and give to the poor. So whichever one's doing really well, take money out of that, move it to the one that's done the worst.
But this is a long-term strategy, right?
Very long-term strategy.
Yeah.
But it will outperform buy and hold those same 10 things. If you do nothing, buy the same 10. I've proven this time and time again to myself. Take those 10 ETFs.
Okay.
Don't rebalance them. There's a research paper on enjoytheride.world that shows the study. If you take and rebalance versus not rebalance.
How often do you rebalance?
If you can do it, the more you rebalance, the better if there's no cost.
Okay.
If the cost of rebalancing in commissions or slippage is very great, then doing it a little less often would be more appropriate. But the commissions have gotten so inexpensive these days that you can afford to rebalance. In some cases, ETFs are very, very, especially if you're trading a big portfolio, it's just not that expensive. So I'd rebalance as often as you can stand doing it, and you will actually benefit yourself. You will actually get a couple % edge on buy and hold. So does that take care of the crash? No, it doesn't take care of this recent crash. There you have to do something a little bit more active. Maybe you have to put some stop losses behind each of the ETFs so that, like in my IRA, I have an ETF strategy. I'm 100% cash a long time ago. Just watching this, it kicked all the stops off, and I went from 23 positions to 0 inside of about a week and a half or 2 weeks.
Okay.
And so,
that's why I mentioned one thing about PE ratio, because in Singapore, there is a lot of courses about, because both you and me are more system traders, you know, but in Singapore there's a lot of people talking about value investing, you know, like
Sure.
what is your view of those value investing? Like,
I think they have their own edge, and if that's your slant on life, it's perfectly okay. Warren Buffett's made a lot of money just buying inexpensive companies and holding them forever. He's had his days in the sun and days in the doghouse too, just like every trader, but he's a longer term guy, and he looks at the companies from the standpoint of the business. And there's nothing wrong with that. But he has to be able to sit there and say, I've got billions tied up in this company and it just went down 30%. I'm okay with that. I'm going to buy some more. You know,
So
and
you have
most
the
people, it's mental.
Yes.
It comes back to mental, because if he's got to, you know, if you're going to buy and hold, then you got to be willing to say to yourself, I think the stock market in the US just went down 32% from top to bottom, if I remember the number right.
Yeah.
I didn't sit there and calculate it. I heard it on the news or something. And so if you are, and by the way, when I came out of college in 74, it had just finished up a 50% down market. The tech crash, some of the tech bubble in 2000, 2001, that was, some of those guys were down 80%. Okay, so if you're going to go in and buy and hold, I encourage you to realize that you are going to put yourself into probably a 30 to 50% down somewhere along your lifetime, if you're young enough.
Yeah.
I'm not okay with that personally. Maybe you would be. Maybe Warren Buffett is. But you have to take on that kind of mentality. And as long as you're okay with it and say, that's okay, I'm young, it'll go down, I'll just buy more, no big deal. All right, that's fine. But what I see happening, most people will say, oh, I can withstand quite a bit of risk. I'm just going to buy and hold. Then when it goes down, all of a sudden they're not so comfortable with it anymore.
And they may sell.
Then they abandon it right when you shouldn't, because now it's ready to go the other way. Now we've just had, I just heard this morning on the news as I was getting ready to come in here to the office. I heard that in 4 days, the U.S. had the best stock market return for a week. And we're not even trading today because it's Good Friday. Best return for the week since 1974. Okay, how many years ago is 1974?
That was
Holy
1 year
mackerel.
ago.
You know, that's back when I'm getting out of university and I'm, you know, like 22 years old.
Yeah.
I'm 67. So you're talking a massive amount of time. Never has the market had such a good week.
Yes.
Now, that's right in the face of what 2-3 weeks ago we're dropping, you know, 10, 20% a week. It's insane. And so you have to be able to say to yourself, okay, it's down 32%, but I knew that that was part of my strategy, because that goes with the flow there. And as long as you're okay with it, I'm okay with it. That's your strategy.
What about opportunity cost? Like if the stock is down like 40% and then you have to hold for the next 1 year, you lose out in opportunity cost, right?
Exactly. But, you know, guys like Warren Buffett over the long run have worked magic with that. So yes, you're right. And that's what bugged me to death. So I would not trade that way myself. But I'm not saying it's not a way that a certain individual, like a very busy, let's say you're a young doctor and you're making a lot of money and you dollar cost average. Okay. And the money's coming in all the time, and so it's down 32%. You buy, you buy a third more shares at the lower price, and over time that ends up giving you an edge.
I understand.
Over
so
your
a lot
lifetime.
of things is about your personality or your how much time can you devote to this thing, and
it really comes down to, can you run whatever strategy you come up with? Because having no strategy is still a strategy. You know, if you want to buy and hold and not have a strategy, that's still a strategy. It may not be a really good one, but it's definitely what's going to happen. And so are you designing what you're doing to match you and your puzzle that you're solving.
Mhm.
Because when you do that, then life gets a lot easier and you can enjoy the ride. And it's, you know, the market goes up and down, does its thing, and you just go along for the ride. And you understand what you're doing. You understand the risks of what you're doing. You're not surprised by anything. So therefore your emotions don't go up and down a lot. You don't get a lot of excitement out of it. If that's
Yeah.
what you're looking for, that's a completely different puzzle to solve. You might as well go to the casino or something and get the excitement gambling. But
Understand.
if you're looking to just be a serious investor and make some money over time, you know, design your strategy so that you're comfortable with it. If 1% of equity and volatility is too fast a movement and it catches your attention and you get emotional when it goes up and down, make it 0.5%.
Understand.
Make it smaller so that it doesn't catch your emotion. That way you can be even keeled, make your decisions rationally, keep going for the long run.
Understand. How does one speed up this process? Because yes, what I hear is correct. I need to know the strategy according to my personality. But sometimes you need to lose money to learn the mistakes. So is there any way that we can speed up this whole process?
I would say yes.
How will you do that?
I'm not sure. I'm not sure that I didn't speed my own process up by reading the chapter on Larry Hite, for instance, in Market Wizards. That helped me understand risk control. I later, very shortly after, developed volatility control, reading some other comments of other traders. I would say that EnjoyTheRide.world has got a wealth of stuff. Just look at the recommended reading list, and for a few $100s, you could get a wealth of information of what other people have talked about in trading and give you some of the principles that might help your cause. And I have the recommended reading list in the order that I would recommend them. So Trade Your Way to Financial Freedoms first, and
Okay.
my own book is, you know, number 4 or 5. It's not number 2, I don't think.
Yes.
And the reason for that is because I think you need a basis of the overall trading process before you get into specific topics like position sizing.
Understand.
I think that's a way to jumpstart. Another way to jumpstart is to, to come to calls like this one. I'm sure everybody on this call already probably has a few ideas that may or may not affect their own trading just from listening to us talking. And I think that, you know, it may cause some people to question what they're doing, and that might be good. There might be reinforcing to other people about what they're doing, and that might be good. But there's I think trying to find what suits you is going to be your answer. And so you're seeking out the overall structure of the process by going to places like, you know, my site or other books and video series and things that talk about this. And then you have to take what comes through in that and say, okay, I understand I need a buy-sell engine of some sort. What is my specific buy-sell engine going to be? And it might be moving averages over a 200-day period. It might be, you know, the Keltner bands we mentioned a while back. It might be Dungeon channels. It might be doing day trading because that's where you want to, you know, operate. You have to design everything for you. If you don't, you're swimming upstream. You're really fighting the universe every day of your life, and it's no fun. So that's the way to get ahead and to jumpstart it, is to understand the process. And I think we've talked about it pretty clearly here. And then to try to find the details for yourself within that process. And that will get you as fast as possible to where you want to be. I think.
Just to summarize, just like you talk about 3 parts: the buy-sell engine, and then the money management engine, and then the last one is really the emotional part, you know, the execution part engine. Yeah, that's
exactly.
the three parts of.
That's the way I look at it.
Okay.
There's some ancillary other things you could do, portfolio risk and other things that that are in there. But I think that if those 3 things would probably be what you need to worry about. And I'll tell you how I would rank them, which is very interesting.
Yes, yes.
Most people, this was a good example. I did a webinar on buy-sell engine, and I did a webinar on position sizing,
Yeah.
and I haven't done one on mental yet, but I'll probably
Yeah.
do one in the future.
Yeah.
In my mind, mental is the most important because you can screw up the other two if you don't do the mental right, right? And the position sizing is far more impactful to how your emotions and mental are going to operate than is the buy-sell engine, because the buy-sell engine, you know, if you take Keltner bands, well, a good example, the hedges that I put on my stock portfolio side of things during this recent crash, all three indicators that I have on my hedge page at enjoytheride.world, I spell out exactly the math behind what I do in detail. And every single one of all three of those went over exactly the same day to the sell side. So people obsess over, oh, Tom uses Keltner bands. Maybe I should use Keltner bands instead of Dungeon channels. Or no, if you run them all against each other,
it's about the
they'll
same.
all do about the same. They'll all give you similar signals. It's whatever you understand and what you can use easily to solve your own puzzle. Don't obsess over it. So the buy-sell engine, I actually did a study once where I flipped a coin, random number generator, to buy or sell. I position sized it based on that risk, the risk that I put in, and I used like an ATR stop on that study. And then I trailed the stop dutifully. So whenever I flipped it long, I bought. I put the stop behind it, and I just kept moving the stop up and moving the stop up. All right. And then when I'd stop out, I'd flip the coin again. Buy, sell, whatever. Every time you have a major run, you're always in on it, because even if you flip it wrong, let's say it's going to be a big up move, and you flipped it because you're out of the position, you hit your stop, you're now cash, so you want to put it back in the market. So you flip it and says go short. All right. So, well, the market's going up. Well, you're going to hit your stop out. Then you're going to flip it again. And one of those flips, you're going to go long.
You're going to have trend.
You're going to catch the entire rest of the run, and that's where you make all your money. So it turns out with a random number generator across, I think I used 20 markets. This was a study in futures, actually. I actually had a slight propensity. It wasn't much. It wouldn't be a strategy that I'd recommend, but it shows how minimally important the buy-sell engine is compared to doing good position sizing, doing good risk management on your stops and stuff, and being disciplined and following the strategy. In my mind, the mental side is most important. Position sizing is second most important. And the buy-sell engine is the least important. But most people, when I did a webinar series, I had 120 people sign up for the buy-sell engine. I had about 35 for the position sizing. Nobody cared. And then I haven't done mental, but I'm almost afraid to, because almost nobody will show up. And so it's funny how people do exactly the opposite of what somebody who's done it for 45 years thinks about the topics. And so I would encourage you to study the mental side and to increase your awareness, for instance. There's lots of books on increasing your awareness and things like, a lot of Tharp's material that he talks about, Dr. Tharp over in North Carolina. The Tharp Institute does a lot of mental side of trading courses and things. Examine yourself, because you are the one that holds yourself back a lot. And people don't realize, they don't ever sit back from themselves and observe themselves and say, it's really me that's screwing this up. It's not the Keltner band. It's not my position sizing. I'm the one that didn't do the trade like I was supposed to do the trade. And now I'm wondering whether I should get into the trade or not, because now I'm late. And is it too late to get in now? I get these questions on direct messaging. I was supposed to buy SPYs a week ago. Is it too late now?
Yes.
How do I answer that one?
Yes, I also get very similar question.
I don't have a crystal ball. I'm running my stuff. I'm doing my stuff. I'm already in on it. Sorry you missed it, but this is your trading strategy, not mine. You gotta come up with your own. You got to learn from that and say, I'll never do this again.
Mm.
And then you got to really mean it, and you got to do it.
Yeah.
And I take my computer along on vacations, and my wife knows that for 20 minutes a day on vacation, I get my processes started, I ship my orders, and then I'm back on vacation. But she gives me that 20 minutes. It's part of the deal of being married to me. And she's okay with it. She understands that it's how we live. So you got to think through these things and design what you're doing to fit your situation, and including what happens when you get sick, what happens when you go on vacation, what happens when the kids get sick, or you have to go pick them up from school because they were not a good boy or girl, and you have to discipline them, and it distracts you from your day trading or whatever. You have to think through what you're going to do and whether or not you can do it, and that's going to help you be successful.
Yeah, so it's really about psychology first, and then position sizing second, and the buy and sell is really the last.
Yeah, it's important to trigger you and to cause you, and you want to do something that is easy to do and that you understand. Like a moving average is simple, and a lot of people understand it. And if you're just doing once a week trading, that's probably a perfect place to start looking and understanding. But you have to come to grips. If you're not a mathematician, maybe Bollinger Bands with standard deviations and all this stuff is a little bit, I don't understand what a standard deviation is. You don't want to get into that. Well, that's fine. Because do something like a Keltner, or if that's too complicated, do a Donchian. That's pretty easy to understand, or look at some other indicators. There's price channel indicators that do this. There's lots of different ways to trade. But the buy sell engine needs this. You need to understand it well enough so that you're not afraid of it. And because that's just going to make you uncomfortable, and then your mental side screws up.
Talking about the mental side, besides reading books from Van Tarp, is there any other things that you do that can help you to be better in your psychology?
Right. I think I would say being able to step back and observe yourself. So if, for instance, keeping a log at the end of the day of trading, if you could sit down and if you had made some mistakes, or if you followed everything you're supposed to do and lost money, even following your strategy, you lost money. There's days I'm down. I don't make money every day.
Understand.
But for me, I understand exactly how I lost that money. And it isn't necessarily a mistake on my part. It is my strategy matching up to the market. And if I can step back from that and say, is there anything I learned from today that would cause me to think of an even better way to trade, so that this type of a day I could actually exploit that move in my favor instead of losing money? Maybe there's a strategy I can come up with that exploits that situation.
Understand.
You then separate yourself from the emotion of sitting there in front of a screen and reacting. And reacting is always, you're one step behind it. The market's throwing stuff at you, and it's pushing your buttons mentally. It's trying to find out if you're greedy, find out if you're emotional, and it's going to cause you to do the stupid thing. If you can then sit back after the markets are closed for the day and just analyze the day, imagine that you're somebody critiquing yourself. And what did you learn? What did you do well? What did you do poorly? That's very educational, because it starts getting you into more of an awareness of the types of things that you repeatedly do that don't make any sense long term, but you keep doing them. And you can ask yourself, why do I keep doing them? And is there something I can put in place to prevent myself from doing them? Or, scheduling myself better, or, locking the door so the kids don't come in and bother me, or whatever it is.
Yes. So it's awareness, right? Yeah.
It's different for every person, but, my mistakes would be different than somebody else's mistakes. But I think that's very educational in the mental side, because it helps. It's just like if you're training for the Olympics, you're trying to get done with your rehearsal or your practice and say to yourself, okay, I did X seconds on this particular run.
Mm.
How do I make it a tenth of a second better? What is it that happened? Let's analyze how I launched myself.
Mm.
Let's see how I came up to full stride. How did I cross the finish line? What can I learn from analyzing all that to do it better? And that's sort of the same thing mentally. And I don't think a lot of people just get through the day and they made money, they lost money, and they go off, go out to dinner. They don't think twice about what they did that day. And I think when I've tried to observe myself, what ends up happening is you start observing yourself live. You don't observe yourself once a day like I did, when I was in my 20s. Now I can actually, part of my brain, this is weird, it's going to sound weird. Part of my brain is watching myself move my hands like this and knows that I'm doing it. And the other part is concentrating on what I'm going to say next. It's bizarre, but there's like two parts of my brain going on at the same time, all the time.
You step out of yourself to look at yourself.
Exactly. That's a strange way of putting it, but that's about what it is in my brain.
So I think,
and that's a learned skill. I did not have that when I was a child. I didn't have that. I was very, very shy. I got good grades as a child, but I was frequently bullied. I was just the little intimidated little kid growing up as a elementary school. And as I got more into the workforce and started trading and learning more about myself, I have the confidence to go on and speak to hundreds of people, and I'm perfectly normal with it and having a good time. I think that's something because of the observation, the observer self, if you want to call it that. And there's lots of books written on the observer self. So you can go Google that word, and you find out all sorts of different articles and books. But to try to actually see yourself doing things while you're trading helps even the discretionary trader, because the discretionary trader is very prone to emotional swings, I think. And to try to, if you really look at a lot of good, successful discretionary traders, they're very good at knowing how to just keep themselves even and not let themselves get high or low, and stay detached. They can just keep looking at the screen, stay detached. It's just a bunch of numbers. It's a game we're playing. It's no different than a slot machine. Pull the lever. It is, to them, it's just unemotional. They're just doing another trade and another trade and another trade, and they don't get high or low over it. And they don't even count the money until they walk away. Their job is to trade. And some of them are very good. A lot of these people that do discretionary trading that I've met in my life don't even have college educations. They just come off the street. They're street smart. They find something that works, and they just repeat it over and over again, and they don't think a lot. And
are these people very detached? That means they don't really put any emotion. They're very detached.
Very detached.
Yeah. And then when they feel a certain emotions, they say, instead of saying I'm angry, they say I'm feeling the feeling of anger. Yeah, something like that.
Exactly.
Right? Because when I do some kind of meditation also, where I also do the same thing and look at. Do you meditate, or do you think meditation?
I have meditated in the past, but what I found out was when you meditate, you're trying to sort of blank your mind. In my mind, you're sort of trying to just slow everything down, and that's really good for your blood pressure and other things. But for being aware, I am not sure how much it increases your awareness, because for me, just doing an exercise, for instance, like if you wanted to practice speaking, go in front of your bathroom mirror and give a small speech. To who? To yourself. You're standing there watching you give the speech, and you're seeing your facial expressions, and you can tell whether you're smiling or not, or if you're frowning or anything else, because you're watching yourself do it. You're feeling your facial muscles. You're thinking of what's going on in your brain, and you're actually sort of creating an observer self situation in an artificial world.
Yeah.
But then once you get good at doing that, you
Mm.
can start saying, well, I can kind of guess what my face looks like without looking at the mirror now.
Understand.
I can tell I'm smiling because I can feel that I've got, there's a little tension right here in my cheeks. And that means my cheeks are being pulled up and I'm probably smiling. All right. And so what you end up with is by doing exercises and observing yourself, you get better and better at observing yourself, just like you would practicing running or playing golf or anything else, in
So
life.
just the act of doing that makes you better.
I
Just the act.
think rather meditating doesn't give you that feedback loop
Right.
as much, but it does some good positive things. I'm not against meditating. I just think that to me, it calms my mind, meditating. I don't know that it increases awareness as much as just observing yourself doing things.
That's the fact of that you are observing yourself, you get better with doing that, right?
Right. The fact that you observe yourself makes it easier to observe yourself.
Interesting. Yeah. So it's almost time. Maybe just one last part. Any advice you have for everyone if those 100 and just now we have 160 people, now about 140 people. Any last advice for them to be a profitable trader? What would be the advice?
My advice would be to create a process for yourself that's designed for you.
Okay.
Execute it 100% of the time and enjoy the ride.
Enjoy the ride. All right.
Because it will be a ride.
Yes. I want to thank you so much for doing this. I really appreciate your time.
Colin, it was a blast. I enjoyed doing it as well.
Yeah.
And hi to all my Singapore friends.
Yeah. So so just want to thank you for your time. There are people thanking you right now. Yeah, really appreciate here. So for those people that are still here, thank you so much for coming. We will end this webinar. So thank you very much again.
Thanks, Colin.
Okay, thank you.
Talk to you soon. Bye.